In this video, we're going to cover how to dollar cost average with crypto. We're also going to discuss some of the biggest mistakes that people make when dollar cost averaging. And this is a very important video. In 2 to 3 years from now, this video can make all the difference. So I definitely would recommend that you stay until the end, leave a like. Let's get into the content. Welcome aboard the Bitcoin Express. My name is Chase. Let's get to it. Dollar cost averaging means that a person takes their money and buys an asset in smaller amounts over a long period instead of buying it all at once in a lump sum. For example, if someone were to buy Bitcoin at its peak in 2017 at 20K, they would not break even or be profitable until Bitcoin hit 20K again a couple years later in the end of 2020. But if a person dollar cost averages, instead of buying everything at once, they break it up over a long period of time. So they buy a little here, 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 and so on. And there is no one way to dollar cost average. A person can buy daily, they can buy weekly, they can buy twice a week, monthly, twice a month, and so on. Everyone watching is in a different situation, has different responsibilities, and will have a different method for buying crypto. But one of the biggest mistakes that people make, this is the first mistake, is that they do not follow or stick to their plan. The whole point of dollar cost averaging is to remove your emotions, because when the time comes, people, if they're listening to their emotions, will make a very big mistake and buy more of an asset as it skyrockets, and they will buy less, or really maybe not even buy any of an asset as it continues to decline. This is the opposite of what needs to be done. Really, a person should be buying more of an asset as it declines and less as it increases. But this only applies to an asset that is valuable and gains value over time. For example, if you're dealing with Bitcoin, right, it's very volatile. It has its peaks and it has its drops. But the idea is that over time, eventually, it gains value. So as you dollar cost average, you get the average cost over time. But on the opposite end, if you buy an asset that is not valuable, right, it has its peaks, it has its dips, but over the long term, it's on a downtrend to zero, all you're really doing is dollar cost averaging to zero. So you have to make sure the asset in question, this is not just for crypto, this is really for anything, even like stocks or gold, for example, it needs to gain value over the long term. And let's take an extreme example of someone who recently bought Bitcoin at its peak of $64,000. And we're going to plug this into a dollar cost average calculator, which I will leave a link for down below so you can play around with it. So let's say someone had $1,000 to invest, but instead of going in a lump sum, they broke it down, right? So they took $100 weekly, beginning at the peak, $64,000 on April 14th, 2021. Today, even with the Coinbase fee of 0.5%, which is high, they would be down 29%. But if they went in with a lump sum, they would be down nearly 50%, right? 49%. And when we look at this, in both cases, the person lost money. But we can say when they dollar cost average, they padded themselves with some protection, which is the key of dollar cost average. Most people jump into investing and they went to profit, but profit is secondary to protection, right? It is protection first, profit second. Another problem with this chart is that we're looking at dollar cost averaging over a period of only 2 months. Dollar cost averaging is meant to be viewed over a long period, really even years. So let's take another extreme example. Let's take a look at someone that bought in 2017 at the peak of $20,000 and plug it into a calculator. So if they dollar cost average $110 weekly, beginning at the peak, December 17th, 2017, with the Coinbase fee of 0.5, even today with a lump sum, right? If they went in 20K all in at once today, they'd be up about $13,000, which makes sense, right? Bitcoin reached its peak and then surpassed it as I make this video. But if that person dollar cost averaged today, they would be up $56,000. You can see there's a big difference between lump sum and dollar cost averaging. But so far, everything we went over is not that impressive, right? If you buy an asset at $10, eventually if it reaches $10 and surpasses it, of course, everyone is going to be in profit. But with dollar cost averaging, the reason that it is so powerful is that it is even possible to be profitable before an asset reaches its all-time high again. Let's take Ethereum, for example. If someone bought Ethereum at its previous peak of $1,400 in 2018, we would say that they would have to wait until 2021 to break even and become profitable, right? Because Ethereum did not reach 1,400 again until 2021. But instead of going in on a lump sum, people that dollar cost averaged into Ethereum starting at its peak in 2018 would have been profitable even before Ethereum reached its all-time high of 1,400. They would have even been profitable while Ethereum was still below $1,000. And I'm going to show you a clip that I made over 5 months ago showing the power of dollar cost averaging. Let's say I want to use the most extreme example. You wanted to buy Ethereum at its all-time high of $1,400 on January 13th, 2018. And you had $20,000 and you said, I'm going to buy Ethereum, see what happens. Today, you would be down $9,508 or 47%. But instead, if you took that $20,000, even at the all-time high for Ethereum, again, I'm using the most extreme case here, and you said, you know what, I'm just gonna break it down and buy a certain amount weekly, $130 weekly, and even using a Coinbase fee of 0.5 higher than the other exchanges, today you would be up $44,000, up 221%. No one can. So from that example, we can see that a person doesn't always have to wait for an asset to reach its all-time high to become profitable. Those that were dollar cost averaging into Ethereum, instead of buying it in a lump sum in 2018, were already profitable when Ethereum was still below $1,000. And something that is important to note here is that this was over a longer period of time. Remember what we said earlier. Dollar cost averaging is not something to be viewed over a period of a month or 2 months. Yes, in those short periods, it can protect you from losing more than you would have lost with a lump sum. But dollar cost averaging is really something to be viewed over a long, extended period. And then this brings us to another big mistake that people make. So once they decide what their schedule is, whether it is daily, weekly, monthly, twice a month, now they have to execute and actually buy the crypto. And a big mistake that people will make is using an exchange that charges extremely high fees. And I'm specifically speaking about Gemini and regular Coinbase. Under $200, they have fees that are not based on a percentage, but instead based on a flat fee. So $10 or less, 99-cent fee. This is 10%. So under $200, you will be paying fees of 10% or more. And there are many people that dollar cost average daily, and this will wreck them. Even those with a lot of money will dollar cost average daily with something like $50 a day, $100 a day, $150 a day, and they will be destroyed on the fees. So what is the fix? It's pretty simple. Go to an exchange where there are cheaper fees. For example, something like Coinbase Pro, not Coinbase, but Coinbase Pro has much cheaper fees. But the problem with Coinbase Pro is that they do not have automatic buys or recurring buys. And like we said earlier in the video, the whole point of dollar cost averaging is to stick to a plan and remove emotions. And to get around that, we can use recurring buys. We set automatic payments, automatic buys, we set it, forget it, and we continue to buy through the ups and the lows, because you'd like to think that when the time comes, you'll be able to manually dollar cost average, but for most people, it is much more difficult than expected. I can speak for myself at least. When that time comes, right, emotions take over and you do not stick to the plan. So recurring buys, for myself at least, are very helpful. So a way you can get cheaper fees and recurring buys is with Binance US. I definitely would recommend finding a platform that offers automatic recurring buys, because as much as you'd like to think that you'll be able to control your emotions and manually dollar cost average, it is much more difficult than you would expect. And I need to know 3 things from you guys in the comments down below. Number 1, what is your time period for dollar cost averaging? For example, is it weekly, monthly, twice a month, and so on? Number 2, which cryptocurrencies are you dollar cost averaging into? And number 3, which platforms are you using? So put your answers in the comments below. Like this video, subscribe to the channel. Thank you for listening, and I'll see you next time.